Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Ehrman.
Hello, and welcome back to the podcast. Thank you very much for being here. We again are going to do a 2-for-1. And if you are listening to Without the Bank, this is also on Farming Without the Bank and vice versa. So if you've already heard it on one, you don't have to listen to the other one. However, you should share it with your friends, and you should let your friends know that they should listen to the podcast. Today, we are going to talk about a MEC, and that stands for Modified Endowment Contract. And I talk about it a lot, and I saw a comment on one of my Facebook posts about why I don't like a 1090 policy and how the policy could MEC later on. And the guy was saying, not a big deal. The insurance company gives you notice and it can all be reversed, yada, 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 which is true. But let's go over the details, because this is what drives me crazy, is the people that don't release all the details. Okay. Let's use more words. Yeah. I don't typically like a lot of words. I like just to have the answer and move on. But in this case, let's use more words and let's actually talk about what is happening. So here is what a MEC is. It is called a 7-pay test. That's what determines the MEC. And it's a federally regulated, thing. Before, I believe it was 1988, people could put money into whole life insurance and they could just stick a ton of money into these whole life insurance policies and it would never be taxable. And it was absolutely fantastic. Everything would grow income tax free. It was great. Well, then the government got their hands on it and they created the Modified Endowment Contract. And so what that means is it's a 7-pay test. The insurance company looks at the premium over time and says, how much premium could go in over the first 7 years to make that a paid up policy? Anything above that will be a MEC. Some people look at it and explain it as your death benefit and your cash value are too close in relation to each other because we've put too much money in, which is also a fair statement, not technical, but I believe it to be a fair statement. So what happens in life insurance, and this is very technical, I'm going to use technical terminology, is that it is called first in, first out. So whatever you put in for premium, that's first in, you get to take out first, or you get to borrow against first. So let's say that we've put in $100,000. Okay. That is our basis. Basis means the amount we've put in. The total amount we have paid in premium is our basis. If we have paid $100,000 of premium, that is our basis. Now, if our cash value is $110,000, then we can borrow. And when we borrow, if it does not MEC, that means we're going to use our basis first. First in, first out. Okay. The $10,000, nothing happens with that extra $10,000 until we physically take it out. We could borrow 110, nothing's going to happen. If we take out the $10,000, then we're going to have to pay taxes on the growth. Okay. First in, first out. If a policy becomes a MEC, then what happens is it's first in, last out. So when we go to borrow money or when we go to withdraw money, they give us the interest earned first, and then we get our basis. So now if the policy MEC'd and we went to borrow money, they would give us 10,000, right? They would lend us 10,000. We're going to have to claim that as interest income because we went and borrowed it. So what we try to avoid in a MEC situation is we don't ever want to use our earned money first. We want to use what we put in first. Otherwise, it basically ends up to be a 401k or an IRA. It acts like that, right? We have to pay tax on the growth. So a lot of people will push that line when we have premium set up. The more premium that goes to cash value, the more likely a policy is to MEC. So we have to be very careful when we set that policy up that we don't get it so close to that line that it will get thrown off. And so I did this on one of my policies, and it just happens to be my mom's policy, is that I submitted her policy to pay monthly. But now she wants to pay yearly. Well, I can't change her to annual. If I change her premium mode to annual, now all of a sudden her policy MECs because the cash value gets into that policy quicker and it acts differently. When you pay monthly versus annually, your cash value grows at a different speed. Even when I run illustrations, annual versus monthly, it's different. Sometimes we can't avoid it. It's no big deal. But with my mom, I got her so close to that MEC that if I change her mode, it throws it off and it would cause her policy to MEC. Sometimes if we do what's called a reduced paid up, it will MEC a policy, meaning we are not going to pay any more premium ever. And it could MEC a policy because we're doing the reduced paid up too early. If we get dividends that are too high, then it could cause a MEC in the policy. I have had clients that their policy MEC'd because the full premium wasn't being paid, dividends were being lowered. Like there's all kinds of goofy things within that policy that could throw that into a MEC. I have clients who pay, let's say that they can put extra in year one. So we've gone along all year, and let's just say that they could put an extra $30,000 in year one. But they wait until the month before their renewal date. And if that's the case, we've earned interest for 10 months. Now we're at month 11. We want to put the extra 30 in. That could MEC the policy. So now we can only put in 28. Okay. A MEC is not the end of the world, but we want to avoid it if we can. Not the end of the world. So let's look at all of these little strategies. If the policy MECs and that policy were to endow, meaning we outlive the policy. So we live to 122. And now that policy MEC'd, we have to pay tax at 122 years old on everything over what we've put in as premium. Now, this is a horrible thing. That is horrible if we are issuing our policy and we're 25 years old and we die at 122, right? That's not good. That's like 85 plus years of growth. So we don't want to do that. If we are 75 and the policy MECs at year 7 to year 11, probably not a big deal because we're in our 80s. And I just did one of these today. I have a client who does not want to continue to pay her premium because they're having some bad times. So we don't want to continue to pay our premiums. So we are doing what's called a reduced paid up. Her death benefit's going to reduce. Her cash value will stay the same, but no more premium is due. Well, that's going to cause her policy to MEC because we're in year 3 of the policy. We shouldn't be doing a reduced paid up till at least year 7, year 8 or later. Okay. But we're doing it now. So what's going to happen is she's not going to have to worry about anything till year 11. That's when she's going to make a little bit of money. But it's going to be $1,000 at year 11. So at year 11, if she borrows money and she borrows the full amount, she's going to have to pay tax on $1,000, interest income on $1,000. Then what happens is if she pays the 41 back, that becomes her new basis. So now her basis was no longer 40, it was 41. So now when she goes the next year to borrow 43, she's only going to have to pay tax on 2,000, not 3, because she already paid the 1,000 back and that is now considered her new basis. Now, this is not a big deal because at 88, she's going to only have like $17,000 of growth in that policy. None of her numbers, doing her reduced paid up so early, none of her numbers are going to be astronomical. We're just merely saving a little bit of death benefit and giving her access to cash without having to lose anything. So in this scenario, a MEC is not awful. What I don't want is a MEC when we're 20 years old or 30 years old or 40 years old issuing a policy, and now we have a MEC at year 40 or 50, because that's going to hurt. Here's what happens. This guy that commented, here's the piece that he left out. He said, well, they're going to send you a letter. They'll fix it. Yes, they do this. I've had clients that get MEC letters, at least 1 or 2 a year. What happens is they send you a letter and you have 30 days to respond. And if you do not respond in those 30 days, that policy will MEC and they cannot reverse it. Who opens their mail in a timely fashion all the time? Not everybody. You guys, I have people who have lost their life insurance because somebody was in the hospital sick, whether it be them or a family member, and we didn't get to our mail because the last thing that we're thinking about is, oh, great, our life insurance company sent us a letter. Big deal. Who cares? I paid my premium. I'm good to go. That's what we're thinking in our head. Now, I also get this letter. But here's the other issue. Is USPS is not the most reliable company on earth. And these insurance companies typically do not send emails. They typically don't call you. And so until they have the overhead and the means to do that, we are risking not opening a letter for 30 days. What if your life insurance agent quit or died? Right? Y'all know that if you have a life insurance agent, chances are they're probably not going to be around your entire life because it is a hard industry to survive in. So as easy as that would say, oh, they'll fix it. Yeah, they will. But we have to watch for it. And believe me, I'm writing policies on people that are in their 20s and their teens. I am not going to outlive these individuals. I am most likely not going to be here if something happens to be watching that. And hopefully the person that takes over my book of business does. So as willy-nilly as it sounds, oh, it's not a big deal because they can fix it. That's not the whole story. And it isn't a big deal if it is done correctly and if you understand how it works. Okay? So if you have to withdraw money, let's say now that you're not taking a loan, but you're withdrawing money. If you are going to withdraw money and it MECs, you're going to draw out the cash first. or the growth first. If you're not 59 and a half, now it turns into a 10% penalty because it starts to act like an investment. And so we want to make sure that this does not happen unless absolutely necessary. And here's the thing, insurance companies, I don't know an insurance company that does not do a MEC calculation with every single payment that is received. So they are always watching for this, always. And the company could miss it. I suppose that's something that could happen, but we want to try to avoid it and set the policy up so that does not happen. Now, in a 1090 policy, we are more likely to see that happen. In fact, I met with somebody that received an illustration from another agent with a 1090 policy. That policy actually MEC'd at 68 years old or 65, something like that. And they did not bother to inform the client of this. Well, we've put so much money in up front, even when they stopped paying the extra premium, the policy still MEC'd. Well, what is causing it in that illustration? Too much money up front. As an agent, I'm always having to balance the act because it tells me when the policy is going to MEC. So I'm having to do this balance act of how much money can I put to cash value, how much to death benefit. And that is why a 60-40 policy split 60% to cash value, 40% to death benefit. That is why those policy splits are very nice, or a 50-50, because we can put money in forever without it MECing. We don't have to worry about the MEC. We've given ourselves enough breathing room and we've still got a good policy. So as much as people want their money up front, we have to be concerned about the MEC long term. And if you're 80 and you want to put a single premium in and it MECs, I'm probably not going to care because you're 80 or you're 85, right? But if you're 20 and 25 and 30 and 40 and 50, yeah, I'm probably going to care what that is going to look like, especially are we going to need it? The client that I talked to today that is in her 60s, we're doing this reduced paid up. She's like, yeah, if I need it, I'll worry about it, right? Because there's such a tiny amount of money in there that she's probably not going to need it with everything else she has going on. So I knew that a MEC wasn't going to be the end of the world. I kind of jumped all over there and I apologize. I even have a note. I even have a list of what I wanted to talk about in an order and I didn't do it because it's just not how my brain works. And that's how my conversation went with myself. So if you don't understand the MEC, I hope that cleared it up. So sometimes it's not bad. Sometimes it is bad. And we just want to try to avoid it if we can. If we can't, not the end of the world unless you've had this policy for 50 years and the darn thing MECs. And then it's the end of the world because maybe we have $1 million of growth in the policy and who wants to pay tax on that before we get to use your basis? That's my big issue with 1090s along with other things, but that's not my number one issue. Number one is the risk of the company. Number two is the MEC. But long term, we could definitely have some issues there. And that's this MEC is a lot of the reason people quit using whole life is because they were like, oh, I can't put it in a policy anymore without it growing taxable. So I'm just going to go put it in an IRA. When in fact, there's ways around the MEC, which is just start more than one policy, right? Because that's what Nelson did. And that's what Nelson taught us to do. So as some people might seem to make it sound that it's super easy, it's not just that easy because we have a time frame of when we need to answer the company. As always, you guys, if you have questions, let me know. MaryJo@withoutthebank.com. If you've not gotten your books yet, go get your books. Get them. Withoutthebank.com and farmingwithoutthebank.com. Grab them. Make your appointment. I am not booking as quickly because it's summer and everybody's in the field. So go ahead, get your appointment. But know also that we have a cancellation list. And we have people just no-showing or canceling the day before because they can get out into the field. Or somebody's mom ended up in ICU or whatever. Like crazy things are happening. And now that the weather is nice, a lot more of that is showing up. So people are getting in. Our list is being used frequently. If you have an appointment in June or July, get on that list so that we can get you moved up, have your numbers ready so that you can meet with me on very short notice. All right, you guys, I hope that you have a fantastic rest of your day and let me know if I can help.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.